Okay, good morning, good afternoon, good evening, wherever and whenever you were watching this. Welcome back. I would say not necessarily by popular demand, but there was a few people who reached out looking for more content out of us. And it was surprising that they weren't relatives of ours. So with that said, we decided, why don't we come back, maybe update where we are. Welcome to 2021, everyone. I hope everyone's keeping well, keeping safe. As many of you watching this probably know, Toronto and all of Ontario has been placed back into a full lockdown, which was unfortunate, but probably necessary. So what Mike and I thought we would do for you today is a quick kind of wrap up of where we were at the end of 2020, now that the end of year stats have come out, and then talk a little bit about where that actually puts us within market context, because I think we hear a lot of times, so here's the number, here's the vacancy rate, here's what rents are. So we'll try to frame a conversation around that. And then I think we want to talk a little bit about kind of where we think this is going to go for 2021. We are hearing positive vaccine news that most willing Canadians will have a vaccine in their arms by September, which is really encouraging. So with that said, Mike, welcome back. Great to see you.
Matt, I love how you sandbag this podcast. Like, oh, we're lucky. People have said this is so helpful and we're getting a nice broad audience. So I think that this is maybe the infancy of a future Joe Rogan show, if we're lucky. So maybe we're a little bit better than we think. But yes, excited to come back with you in the new year and talk about what we think the market's doing. We've got, I like to think we have a bit of a better crystal ball than a lot of the armchair experts on office space right now. And we're going to try to throw some stories and some stats at you to help show you if there are signs of life, and if the office in Toronto is dead for a while, or if it's going to come roaring back.
Yeah, great point, Mike. Listen, I think, so let's start there. Spoiler alert, 2020 was a rough year.
Yeah, it didn't go so well for a lot of leasing. We had the lowest volumes in terms of transactions, really over the past 5 years, potentially more.
It was pretty dramatic. Listen, that's not going to come as a surprise to anyone listening to this. Anyone that follows this knows. Most people watching this are watching from home. We're both recording from home when I think we'd both rather be in the office. So with that said, I think there is some encouragement. So let's just do a quick recap of where we are as of January the 22nd, 2021. End of year 2020, the market vacancy rate in downtown Toronto, 5.1%.
And 5.1%, mind you, which is interesting, is the lowest office vacancy in North America. We've actually had the lowest office vacancy in North America over the past 2 years. So even though our vacancy has jumped, we're still the tightest and the strongest market relative to others.
Well, listen, I think, important point, we can look at that one of two ways. One, the good. We are the tightest market in North America, right? If you want to make an argument that it's a landlord-friendly market still, even though I think that's shifting pretty dramatically, we're still the tightest market in North America. It shows the resiliency of Toronto's office leasing sector over the last 5 years.
And I'm going to make a bold statement, Matt.
Go ahead.
A bold statement here for this podcast. I think that we are at the, quote, bottom of the market now, or within at least a plus or minus 3 to 6 month period of it. This is when you're going to get the best deal. This is when there's the most uncertainty. And even though we're not going to be at peak vacancy rate, this is what we would consider the best opportunity, period.
Okay, so let's define that. Let's define that a little bit for me, because not to play devil's advocate. So let's look at where we're at. We're at 5.1%.
Play devil's advocate.
Just we're at 5.1% vacancy. We're the tightest in North America. With that said, our vacancy rates went up by 2.5 times last year, right? We started the year at 2%, we ended at 5.1. That is still more on a percentage basis than most of our other major metropolitans that we're saying we're tighter than. So you can make a couple arguments towards that. One, we had a significant amount of space come back to the market. Two, we were at 2% anyways. Like it's not that dramatic because we're still the tightest in North America. I think one of the interesting things we should talk about is vacancy is always a lagging indicator on where a market actually is. It's usually 6 months after.
It's going up. Yeah. So we're not done at 5.2%. We should see more vacancy come to the market even over the next year or so.
Right.
Because we hear things like the banks, they haven't really added a lot of space to the market. They're going to let some leases roll. We understand that there are certain banks that have expiries in the next 2 years that don't plan on taking occupancy of that space. They're going to consolidate in some of their other newer buildings and change their workplace strategy. So also, the rate it's not going to stop going up.
Right.
But you just said vacancy is a lagging indicator.
That's right.
And as a lagging indicator, whatever the market sentiment is today is going to impact vacancy rate a year to 18 months from now.
That's right.
The day that we're at peak vacancy is a period where there's lots of deals getting done to reduce vacancy for the following year. So vacancy is not the bottom of the market when vacancy peaks. It's really a year before vacancy peaks. It's really the best deal.
I agree. So I think the other interesting indicator, everyone focuses too much probably on vacancy rates right now. There's 2.5 million square feet of available space on the sublet market. So I want to quickly define what that means. Generally, we sit between anywhere from 600 to 700,000 square feet on the sublet market at any given time in downtown Toronto, which represents just under 1% of the overall inventory of the 70 odd million square feet in downtown Toronto. We're at 2.5 million square feet today. In the 10 months since COVID hit, we've already well surpassed where we were in 08-09, which was only about 1.3 million square feet of sublet vacancy. So to your point about it being a lagging indicator, if those tenants who have put their space on the sublet market were to just let their spaces naturally expire over the next few years as those sublets come up, or if they were to downsize in half, like I think a lot of them are looking at right now, we could really see that sublet or that vacancy rate overall peak. And I think what you wanted to talk about was where that projection could end up in terms of the high side of vacancy, but maybe as well where it could end up on the low side, because I'm not sure I buy that we're not going to bounce back to this really quickly. Like I think that everything I'm hearing from clients right now is they anticipate their employees will be vaccinated by the fall. They are starting to plan to be back. They're starting to plan to be back in the office at the end of this year into next year. And there's a lot of optimism right now. Well, I should say there's as much optimism as you could possibly have given that we are in a government issued lockdown.
There's a couple of interesting points there. Yeah. So when we talk about the bottom of the market and what does that mean? We have a lot of clients, as you just mentioned, who are planning to come back to the office in the fall with a vaccine rollout. There's a lot of fatigue working from home, and they're going to come back to the office in some context. Let's ignore the change in square feet for now. Just that companies will return to office. If all these companies are planning on returning to office in the summer and in the fall, whereas right now there's very little activity in the market in terms of new leasing.
That's right.
That means that there's a lot of backlog from really the past full year that's going to lead up to the second half of 2021, where there's going to be a lot more activity. So if you're a landlord, let's say right now today, and you're sitting with a big block of available space, there's not really a lot of big blocks actually, you're sitting with a piece of vacancy. And right now you're getting no tours. We're in lockdown, you haven't had a tour in months, it's been really quiet last year. You're probably gonna say, hey, wow, a tenant's on the street today, I'm gonna be really aggressive to get a deal done. Fast forward to July, when tenants are optimistic again and they return to the office. That landlord that had no tours on their space earlier in the year last year now has 3 tours, 5 tours, because all tenants are kind of planning their reentry at the same time. So even if vacancy is higher in July and August than it is today, and it will be, if the landlords see activity pick up and competitive bidding and competitive dynamics on their spaces, they're going to hold rents higher because they're looking a year out from that. They're seeing things returning to the market from increased activity. So when we say bottom today, part of this hypothesis is if every tenant's waiting to come back to the market, if everyone's trying to do the same thing, then you're not going to get the best deal when everyone's doing the same thing trying to find office space.
Yeah, so I agree. You're right, which is tough for me to say.
I was hoping you'd be devil's advocate here.
Well, here's where I'll maybe pick and prod a little bit. I don't think necessarily we're at the bottom or the top. We're stuck in uncertainty. And I think there's a difference to that. A bottom of the market or a top of the market is based on some pretty significant economic factors. Things are going up or things are going down. Just give me a sec. So where I think we see a lot of issues in our industry is when there's uncertainty, right? Deals aren't happening right now. Like let's be very clear. There was one major transaction that happened in Toronto in 2020 was a net new deal that started during COVID. I'm sure everyone read the press release in the Globe and Mail when it came out with this tech firm. It was really the only deal that started post-COVID, completed post-COVID, and is setting up for a vaccinated world into the next couple of years. So
one of the largest companies in the world, big tech, reinvesting in office space downtown in COVID.
Correct. But the issue,
Matt, in terms of uncertainty, is the economic dynamics don't dictate the bottom of the market. Uncertainty dictates the bottom of the market. Massive uncertainty is the bottom of the market, not the worst economic situation.
Well, I'd make
it's forward looking.
That's fine, and I don't disagree with I think we're trying to say the same thing. What I'm trying to say is this uncertainty right now is good and bad, because let's say you were to link your deal today. To your point, this is, in Mike's analysis, this is the bottom of the market, you'll get the best deal. The issue is you ink the deal today, and let's say we're not back in the office. Let's say you signed a deal today for October. Okay? We think we're going to be vaccinated by October, back to the office by October. Problem is, if you're not back to the office until March of next year, now you just inked a deal where you paid for 6 months of additional rent that you did not have to pay for. So I think that's my point with uncertainty, is that it's tougher to gauge where the end is. I think we can both agree the end is in sight.
Right. It's a stock market analogy is what I like to use.
Sure.
Market was going down March of this year. Market's falling. Do you know that you're going to pick that bottom date you're going to buy? No. If you buy on this date, you might lose another 5%, 10%. But if you miss it, you've missed a 25% pop the other way.
That's fair.
So you're right. There is obviously risk with buying into a bottoming market. And you're right. If you ink a deal with an October start date, you might have been better off making it January or March of next year. But if you wait, there's a good chance that you missed in potentially tens, hundreds, if not millions of dollars of potential inducements on a deal that you would not have gotten if you didn't make that transaction earlier. And there's a lot of opportunities. One final point to make on this, if you're a tenant listening to this, is if you sign a lease deal, it doesn't mean, if you sign a lease deal in April, it doesn't mean you start paying rent in April. You can sign a lease deal to start paying rent in October, January, March. You can get all that free rent and get that lead up period so that you can take advantage of the market bottom now and push out that commencement date as long as possible. And that's the advantage of a bottoming market.
So can you, just for our listeners out there who might not be aware, can you walk through, so when you're saying bottom of the market, you're saying your argument is you can get a better deal today than you think you'll be able to get 6 months from now. Can you walk our listeners through what you mean by that specifically? So I want to probe on two things. One, what rental rates might look like compared to where they were, where they're going, or is there a change in that? And then two, I think you mentioned it a few times, you keep saying inducements. So yes. Just walk us through what you're trying to say there.
Yeah, really important. So thanks for clarifying that. In the Toronto market, we look at landlords, and there's not a ton of landlords in Toronto. There's a lot of big institutions that own buildings in Toronto. Think of your Oxford Properties and Cadillac Fairviews. These are what we call big institutional landlords. Institutional landlords will fight tooth and nail to never lower their face rental rates. That's the dollar amount you're paying every month on a per square foot basis. So that face rental rate has to be high, because a landlord, if they were to adjust their rental rates lower, have to revalue the entire property and mark to market their other rents and their forecasts. So if they lower rent on the next deal, that might wipe out millions, tens of millions, hundreds of millions of dollars of building value off their balance sheet. So they're going to keep that face rate as high as humanly possible indefinitely. Now, what landlords will do to keep their rental rates high is they'll induce deals. What does that mean? They'll provide incentives like a cash allowance. Here's dollars cash to go build out your space or put in your pocket, or as free rent. We'll give you free rent on this deal. It's free on us, but you have to keep paying that face rental rate every month. So we talk about bottoming the market. We don't expect pricing to come down today. We don't expect pricing to come down tomorrow. It'll stay relatively flat for the majority of landlords. But because that landlord has been sitting with a space that hasn't had a tour in a year, they're going to give you a much larger allowance and or much more free rent if you do a deal today than if you wait 6 to 12 months and there's more activity in the market where they don't have to give the same inducements and they can keep their rental rates as high as they've been, if not higher.
Yep, I think that's the correct sentiment. It's tough to. I think there's two. There's financial inducements and then there's non-financial inducements. So things like options to expand, things like options to contract. Even force majeure clauses that might not have been any flexibility in 2018, 19, and into 20. Maybe there's a little bit more flexibility. Maybe there's more ROFO rights or ROFR rights. So I think there's inducements that are financial. I think there's incentives that are non-financial. I think everything's on the table right now, except for probably those net rental rates, to your point. And that's an indication of Toronto as a whole.
Yeah, and for these landlords, they look at the bias of these landlords. They enjoyed the hottest office market, the hottest downward trend of vacancy over the past 10 years. So when they're looking at their buildings, even with sublease spaces, they're still collecting rent.
That's right.
They're still doing well. And they're holding firm. They're not excited to move down on those rental rates. And when market sentiment comes back, they still have this inherent ego that's been built. The Toronto's coming back and I'm not reducing my rents. Prior to this pandemic, you were getting zero inducements. So if you wanted free rent, they'd say, too bad, I have another tenant lined up over here. You wanted an allowance? Too bad, you got to pay for yourself. Those inducements got completely removed from the market because it was so hot. So the fact that landlords are now willing to give inducements is a big shift. And they can't wait until they don't have to do that again when things start to recover. So it's going to be hard to move a Toronto landlord off of that bullish nature they had of the market pre-pandemic, even if vacancy increases by another 2, 4, 6%.
That's right. I agree. So I guess last thing quickly today, just because I think we're running a little bit tight on time, in 30 seconds or less, which I know is not 30 seconds for you. Who's leading us back?
It's going to be tech. The deals we've seen so far are both big tech. Here's another quick example here's a company that said they're going to be work from home indefinitely. Twitter, okay? Twitter just renewed in place for 5 years. Like Twitter just renewed their deal after publicly saying early pandemic, they're going to be work from home. So big tech is leading a lot of this charge coming back to the office. And even homegrown companies, there's a lot of local technology companies that have done deals in the past quarters, really the only ones doing deals because they believe in collaboration, and to grow long-term, you have to put people in an office at least some of the time. So these are the companies driving it. It will be tech first. The banks are going to lag because they're always slower moving to do so. But tech has driven the market the past 10 years, 20 years in real estate, really, and they'll continue to do that going forward.
Yeah, I thoroughly agree. Everything we're hearing right now from our tech clients is I would have said a few months ago, it was more, they were looking at the crystal ball saying, oh, okay, we're getting close. I think now they're feeling pretty confident that, hey, here's all the data is starting to support the fact that we're going to have people back to work at the end of this year into next year. And they are planning.
And it's collaboration, right? The reason why Google invested so much in offices years ago, what's a Google office, right? Was because it was the value of the collaboration. And that collaboration is what drives major change and growth of these companies. And we all know the collaboration is not the same quality over Zoom, and that the future will be a mix of both the work from home and the in-person collaboration. but you need the space to collaborate, and that will always be an office.
Yeah, that's absolutely right. And I think you'll see, tech lead Toronto back. I think what's really encouraging is tech is one of the few at this time is actually still growing, ironically enough, particularly in Toronto, engineering hubs, more and more employees looking to be hired for tech companies. It's encouraging. I think this is the first time that we've been doing this where I think we both agree there is light at the end of the tunnel, which is exciting. I think we're both ready to be back to the office. I keep saying back to work, but it's not back to work. We're excited to be back to the office. I know our clients are excited to have their people back to the office. I think a lot of people are starting to understand the whole work from home. This wasn't an experiment. This was a forced work from home. It has pros, but it probably has more cons. And I think there's going to be some sort of balance going forward that'll really benefit companies. But the one thing we're hearing consistently across the board is, boy, we need our office more now than ever, which is great. So with that said, great to see you, like always. I hope everyone enjoyed. We'll be back. I don't know if we're going to put a schedule on this, but we'll be back sporadically. If there's anything you want to hear from us, just flip us a note. Always happy to chat. It's what we enjoy and it's what we talk about anyway. So until next time, Mike, great to see you. Everyone stay well. And we'll see you all soon.
And we can still say Happy New Year. It's still January. Take care, everyone.
It's late January. It's a little late. All the best in 2021. Take care, folks.